Hello, and welcome to Wealth Management Insights. I'm Monica Guerra, Head of U.S. Policy for Morgan Stanley Wealth Management, and I'm recording this audiocast on Wednesday, March 19th. While deregulation is a central component of President Trump's agenda, the meaningful economic and market-related impacts may be delayed as other items like trade policy and fiscal austerity take center stage for now. Policy sequencing differs from Trump's first term, when the administration focused on growth and productivity-enhancing policies at the outset through a combination of deregulation and tax cuts, and later implemented restrictive tariff policies. Currently, the inverse has occurred, with the new administration leading with restrictive economic policies that are likely to be followed by a pro-growth agenda. While sequencing of these policies may impact final outcomes, the balance of risk and reward is critical to assessing the impacts of deregulation on the market and the economy. For example, reduced regulation and government oversight from entities like the Consumer Finance Protection Bureau may result in greater risk to the consumer, increased market instability, and business uncertainty. However, reduced regulatory burdens have been found to provide meaningful tailwinds for market performance. We expect that broad deregulation could have positive impacts for several U.S. sectors and industries over the long run, primarily benefiting financials, tech, energy, and healthcare. Let's take a closer look at the potential beneficiaries of deregulation. The financial sector could benefit from deregulation associated with decreased supervisory oversight, lower capital requirements through the dilution of Basel III Endgame, and reduced M&A scrutiny. Additionally, favorable crypto legislation and regulation could continue to boost retail and institutional adoption. On tech, AI regulation is likely to remain in the back seat as the Trump administration adopts a develop first and regulate later approach. Tech performance will likely be driven by AI adopters in cybersecurity and software. Many of Trump's executive orders have also focused on energy. Although Trump aims to boost energy production, oil production already sits at record highs and is unlikely to meaningfully increase without strong market incentives. Also worth noting is that the Trump administration has embraced and continued the Biden-era policy of supporting nuclear energy, which is likely to benefit from a reduced regulatory burden as large tech companies turn to nuclear to meet the growing demands from AI and data centers. The healthcare sector has also been front and center during this new administration's transition, as regulatory changes could have mixed consequences for numerous industry participants. Pharma and managed care could face pressure from potential Medicaid cuts and vaccine mandate rollbacks, while biotech companies could benefit from rate cuts. For a more in-depth discussion of Trump's regulatory agenda, including the sequencing, pace, and magnitude of deregulatory pressures, check out our latest U.S. Policy Pulse report, Deregulation, Risks, and Opportunities. As always, thank you for listening, and for further information pertaining to U.S. public policy, please ask your Morgan Stanley financial advisor for copies of our latest reports.